Good afternoon, everyone. And thank you for attending this year's event. My name is Dave Lyons. I'm Vice President of, at NFP on behalf of our firm. Thank you very much for attending this year's event. My brother typically does the introductions, but over the years, he has become more nervous while conducting these and asked me that I do the opening. So this is the 19th time that we've hosted this event. And in addition to educating the community in the trends of the economy and other issues that are about, we do like to highlight the importance of the Center of Economic Education and Entrepreneurship at the University of Delaware. So last year at this event, we shared the exciting news that Lyons companies had joined NFP at Aon, an Aon company. And a year later, we're very pleased with that partnership. Everything's going wonderfully well. So with that, I'd like to introduce Carlos Caserta. Carlos, come on up.
All right, thank you everybody for coming today. I think you all know I have an accent. This is the 13th time I do this, and I was told that I need to slow down. So my remarks are gonna seem a little slower than in prior years, but it is forced. And this is the first time I wear glasses because I'm getting old. I mean, that's just part of that. So thank you, Dave. The James O'Neill Award for Excellence in Economic Education and Entrepreneurship was created to recognize, slow down, an individual who has made substantial contributions to promoting economic, personal finance, and entrepreneurship education. The selection committee includes the Dean of the Lerner College of Business and Economics, a senior member of the Department of Economics at UD, the chair, vice chair, and one more member of the Delaware Council on Economic Education, the prior year's recipient, Professor Patrick Harker, and myself. Michael Farr is the chairman of Farr Crest Capital, a private family office dedicated to long-term stewardship, disciplined investing, and generational wealth. He previously founded and led Farr, Miller & Washington, and served as chief market strategist for Hightower Advisors. Over nearly 3 decades, he has guided families through multiple market cycles and helped shape investment strategy for clients across the country. A respected and trusted voice in financial media, Michael is the longest-serving CNBC contributor and sought-after speaker on markets, the economy, and the Federal Reserve. He is also the award-winning author of 3 books, and I'm only going to focus on a couple of them. $1 million is not enough with inflation these days. I don't know when. It's definitely not enough. And Restoring Our American Dream, which I think I am one of those people who benefited from the American dream, and I'm very excited to be here in this country doing what I'm doing. Michael's connection to this award carries special meaning. The Jim O'Neill Award is named after Jim O'Neill, who was a close friend of the late David Lyons Sr., the founder of this event, a connection Michael also shared. That sense of friendship, combined with Michael's and Jim O'Neill's support for this event since day one, they've both been participating on this voluntarily since the beginning, makes honoring him today especially fitting. His contributions at the Economic Forecast have consistently provided valuable economic insights to both our business and educational communities. Almost done. Michael has also been a trusted advisor and champion of the center, offering invaluable support during our major fundraising efforts for the 50th anniversary of the center in 2021. His belief in our mission has strengthened our work and supported our goal of seeing students graduate as informed and productive citizens, contributing to their own prosperity and to the well-being of the world. And on a personal note here, Michael is a remarkable and caring friend. About 8 years ago, he came to this event and was here a night before the beginning of the event, and he gave me a call and said, hey, let's go out to dinner. I was suspicious, but I did go out to dinner. And we talked about life, the future, retirement. I was 40 at the time, so I thought, And then somehow we ended up talking about exercise and taking care of yourself. And I can say without a doubt, and I've told you many times, that conversation changed my routine and honestly, my own well-being. So I thank you many times for that, but it shows the type of caring person that you are to just call me, have dinner, and have that discussion with me. At the time, I had stopped swimming. I was just working. So we are grateful for your many contributions to the educational mission of the center and are delighted to formally recognize you, Mr. Michael Farr, as the 2026 recipient of the James O'Neill Award for Excellence in Economic Education and Entrepreneurship.
That's really cool. Thank you very, very much. It's a great pleasure to be back here. Thank you so much for inviting me again. It's an honor. Thank you. It's a true honor to receive this award. I'm grateful to Carlos very much. To President Laura Carlson, to David, to my friend David for starting all of this, and Tim and Kate, thank you. Thank you. Thank you for the support and the stewardship of this important work. It fosters an institution where ideas and inquiry and public purpose continue to thrive. And to be recognized in this setting among educators and leaders that I respect, who I respect so deeply, is something I value greatly. Jim O'Neill and I did the first one of these together 21 years ago. We were over at the museum. Jim's legacy is powerful. He understood that the most enduring impact in economics does not come from a single lecture or publication, but from equipping teachers and strengthening institutions and expanding access to economic understanding. The idea is a multiplying impact, empowering others to carry knowledge forward. It's both humble and profound. It reflects a belief that economic literacy is not reserved for specialists, but is essential to be an informed and capable citizenry. Economic education matters because economics itself shapes the choices we make as households, as entrepreneurs, as policymakers, and as voters. It provides a framework for thinking clearly about trade-offs, incentives, risks, and opportunity. When individuals understand how markets function and how capital is allocated, they're better prepared to navigate uncertainty and participate constructively in civic life. Entrepreneurship, in particular, sits at the intersection of economics and democracy. It represents agency, the ability to act on ideas. It represents responsibility, the discipline of allocating resources wisely and serving others. It represents opportunity and the belief that effort, creativity, and risk-taking can lead to progress. In that sense, entrepreneurship is not only an economic engine, it's a civic one. It reflects the core promise of the American dream, the great American experiment. The individuals operating within a framework of laws and institutions, that those individuals can build, innovate, and improve their communities, and accomplish things in this country that aren't possible in many other places around the world. Economic literacy strengthens that framework. It strengthens institutions by fostering informed debate. It strengthens markets by encouraging rational decision-making. And it strengthens citizens by equipping them with the tools they need to understand both prosperity and risk. This is what Jim O'Neill has done as his life's work. This is what so many of you continue to do, but those particularly involved with the University of Delaware, Pat Harker when he was president, and certainly as president of the Philadelphia Fed, what I've seen Carlos do for years as well. So I'm honored to be associated with Jim O'Neill's name. He's been a friend a long time, particularly with the mission this award represents. So if my work has contributed in some way to expanding access to economic understanding, I'm grateful for the opportunity to continue that effort alongside all of you. Thank you very much. I appreciate it a lot.
Thank you, Michael, and congratulations. Our first speaker today is Professor Patrick Harker. He's a distinguished scholar, academic leader, and public policy expert with a career spanning the highest levels of academia, government, and finance. He currently serves as the Rowan Distinguished Professor of Operations, Information and Decisions at the Wharton School of the University of Pennsylvania, and as Director of Academic Engagement for Penn Washington, where he helps connect the university's thought leadership with national policy discussions in the national capital. From 2015 to 2025, Dr. Harker was the 11th president and CEO of the Federal Reserve Bank of Philadelphia, where he played a pivotal role in shaping U.S. monetary policy as a member of the Federal Open Market Committee. During his tenure, he helped to guide the economy through significant challenges, including post-Great Recession recovery, COVID-19 pandemic, and subsequent inflationary pressures. He also spearheaded initiatives to advance economic mobility, workforce development, and financial inclusion across the Federal Reserve's 3rd District and nationally. Prior to his tenure at the Federal Reserve, Dr. Harker served to nearly a decade as the president of the University of Delaware, where he led successful campus-wide strategic transformation, significantly expanded interdisciplinary research, and forged new partnerships with industry and government. Earlier, as dean of the Wharton School at the University of Pennsylvania, he transformed one of the world's top business schools by enhancing global engagement. President Harker, or Professor Harker.
Y'all can't get rid of me. You know, I keep coming back. Like a bad penny, but we don't have pennies anymore, so I don't know what we're going to say after that. No, this is great. It's great to be back this afternoon. Good afternoon, everyone. So it's great to be back here at Delaware. This place it's really special in my life. This is an incredible institution, and I was just privileged to be a part of that for a period of time. But the institution goes on. This is just a tremendous university. But as you heard, I retired from the Fed in this past June after a decade of service. Fed has an unusual retirement rule for presidents. It's an age limit of 65, but if you don't have 10 years in, you can stay 10 years. You hit your 10-year mark, you're out of there. I mean, there's no wiggle room. But that, as you heard Dave say, included time on the Federal Open Market Committee. And when I gave this talk before, like last year, I would always have to give the standard Fed disclaimer. I don't have to do that anymore. So consider this, Pat Harker Unleashed. Yeah, so this is what I'm going to cover. First, I want to do a straightforward assessment of the national economy, the puzzles and contradictions that make this moment so unusual. And this is an unusual period economically. Then I want to take a deep dive into a few things, into the labor market, including the January jobs report and the benchmark revisions that really significantly changed our view of what happened in 2025. From there, inflation and tariffs. Of course, you got to talk about the dual mandate, the two subjects that obviously are deeply intertwined. Then I'll update you on where I think monetary policy is and should be. And then I want to talk a little bit about our home state here, Delaware, and what's going on locally as well. And then I want to close, this is the unleashed part, with what I feel very strongly about and have been writing about recently. I want to talk about what the Fed can, and more importantly, what the Fed cannot do, and why it matters for all of us as Americans. So let's get going. Let me start with the big picture. And I have to say, the economic data right now is genuinely confusing. That's the term. On one hand, GDP growth in the second half of 2025 was remarkably strong. The fourth quarter came in above 5% by some measures. That's well above trend. The Atlanta Fed's GDP Now tracker currently estimates first quarter 2026 growth at 3.7%. That's also very high. The economy is continuing to expand. On the other hand, the labor markets are telling a different story, a very different story. We've been in what some economists have called a jobless boom. Strong output without corresponding job creation. Hiring has been weak, layoffs are contained, which is good, but not matched by new hiring. That's unusual and uncomfortable. That's an unusual and uncomfortable combination. So for example, the Philadelphia Fed's survey of professional forecasters, which I'll brag a little, is the oldest continuous survey of economists' expectations for the economy, projects real GDP growth of about 1.9%, this is real, not nominal, for 2025, and 1.8% for this year on an annual average basis. These are modest forecasts. They're pretty much trend forecasts. It's not a recession, but not the kind of growth that can cover up some mistakes either. What explains that divergence? Part of it is trade dynamics. The trade deficit collapsed in the second half of 2025. And that actually, in terms of the accounting, the economic accounting we do, that gave a big boost to GDP, but not necessarily underlying demand. Now, part of it may be productivity gains, possibly AI-related, though it is really too early to tell, and we can talk about that in the Q&A. And part of it is simply that the data has been very noisy, disrupted by government shutdown. You shut down the federal government for 43 days, and another brief one, and now another brief one just in one department. That does distort the data that the federal government collects. So we're still trying to figure out what's signal and what's noise in that data. The bottom line is conflicting signals, strong output, weak hiring. That combination doesn't resolve itself very easily. So let's look at the labor market. Last week's jobs report brought some encouraging news and some sobering revisions to what we thought we knew about 2025. The January report showed employers adding 130,000 jobs, well above expectations of 55,000 to 75,000. The unemployment rate edged down to 4.3% from 4.4% in December. The household survey was even stronger, showing gains of 528,000 workers and labor force participation ticking up to 62.5%. These were good numbers. And after a very weak 2025, that was a welcome start to the year. But the benchmark revisions that came out with that January report were striking. Total non-farm employment for 2025 was revised down from the initial estimate of 584,000 jobs to just 181,000. That is a big revision. And if you think about it, do the math, that's about an average of 15,000 jobs a month, not 50,000 like we thought. Big revision. And the benchmark revision for the period from April 24 to March 25 showed 898,000 fewer jobs than initially reported. That is the second largest downward revision in history. Now, what's striking also, it's not just the numbers. What's striking is how narrow the base for job creation has been in our economy. Healthcare and social assistance accounted for 123,500 of January's 130,000 jobs. That is, the rest of the economy created about 7,000 jobs in this economy. Federal government employment fell by 34,000. Manufacturing actually gained a little bit, 5,000, which is, we've been seeing a trend where manufacturing employment's been going down. But one of the other worrying signs is long-term unemployment, those out of work for more than 27 weeks. That remains elevated at 1.8 million, and that's up 386,000 from a year ago. Got a lot of numbers, but I think what you can see from this is you can see why people feel shaky. And you see that in the consumer sentiment statistics. The Conference Board's Consumer Confidence Index fell to 84.5 in January. That's its lowest level since May 2014. Lower even than the depths of the pandemic. People feel shaky. University of Michigan Sentiment Index, while inching up, remained more than 20% below a year ago. Consumers are feeling the weight. They're feeling the weight of elevated prices and this real sense of uncertainty about what the future is going to bring. So that's on the job side. Let's talk about inflation. We are getting some good news. The most recent CPI report showed headline inflation at 2.4% year over year for January. That's down from 2.7 in December, and the lowest reading since May 2025. Core CPI, which strips out food and energy, that came in at 2.5%, and that's the lowest since March 2021. Both readings were below expectations. I mean, these are good numbers. Shelter costs, what's driving a lot of that? Shelter costs, which has been a stubborn driver of inflation, rose just 0.2% for the month, bringing the annual increase down to 3%. So we're finally starting to see shelter costs come down. Not costs come down, but the inflation come down. Energy prices fell. Food rose 0.2%. Again, another good sign, because that's something that's really weighing on Americans. On a monthly basis, I mean, things look pretty good. That's meaningful progress. Now, the Fed uses their preferred measure as core PCE, personal consumption expenditure. That tends to run slightly below CPI, so we may be pretty close to the 2% target. That's the Fed's target. And we've not seen that target in quite a while. It's now in sight. And we're starting to see inflation expectations come down, so that's good. So why? Why is this happening? Shelter inflation, as I said, is finally moderating as new leases work through the data. We're starting to see new leases come in, and they're lower. Energy has stabilized, and the tariff effects that we feared that would push prices significantly higher have been muted so far. But some of the announcements that some major retailers have come out with recently and other firms, they're predicting, or they're going to implement pretty significant price increases. They've been holding back for a while. But we may see prices continue to rise. We just don't know. We'll have to see. So let's talk about those tariffs. I couldn't talk about this 8 months ago. It was like, you don't talk about this at the Fed, really. But I can now. The tariff environment has changed dramatically. I'll give you some numbers on this. The average effective tariff rate in January 2025 was 2.3%. As of November, it's 10.5%. So we've increased that number quite a bit. This is from my colleagues. I'm going to refer to them several times here this afternoon. The Penn-Wharton budget model. I really encourage you to look at it. It's a great macro model. They do great work, great analysis. That's a fourfold increase in less than a year on tariffs. Now, China faces the highest rate among trading partners, an effective rate of 34.7% as of November. Steel and aluminum are at 39.8%, followed by automotives at 15.3%. Now, those tariffs have already raised $170-ish billion in revenue between January and November 2025. So it is raising revenue, but it will have an effect on prices. So from a monetary policy maker's perspective, tariffs create a real dilemma. They lift measured inflation even when demand isn't overheating. What you want to look at as a policymaker is what's the underlying demand? Is the economy running hot? Well, the tariffs confuse that signal because and the Fed could make a mistake. If it tightens to counter tariff-driven price increases, it may just push this soft, fragile labor market even further down. But if the Fed looks through tariffs too readily and says it's just a one-time price increase, instead of dripping into the economy, it risks inflation expectations getting out of control. So that's the dilemma. So Chair Powell has just recently said tariff-related price increases will be a one-time effect, basically, through mid-year 2026, this year. And I think the recent reports give some support for that. But the concern is these one-time effects, they often have a way of becoming persistent when they come in waves. And we're seeing potentially some more waves coming at us. So what's that mean for monetary policy? This is where I stand. Go back to the January meeting the Fed had. The Fed voted 10-2 to hold the federal funds rate steady at a range between 3.5 and 3.75%. Governor Myron and Waller dissented in favor of a quarter-point cut. So the two dissents, which is a lot in Fed speak. Chair Powell made it clear that the Fed is well-positioned and will make decisions meeting by meeting. Markets currently price in 1 or 2 cuts by year-end, most likely in the second half of this year. So here's my view. Given the recent inflation data and the labor market's continued softness, I think one additional 25 basis point cut, likely in June, is warranted. I think that makes sense. That would bring the federal funds rate to 3.25 to 3.5%. But actually, I don't think you're going to see a lot more than that. Maybe 2, but I'm betting on 1. Why? Because I believe we're very close to the neutral rate. And now I'm going to get a little wonky. What economists call R star. You'll see that the market participants know this term, R star. So what's this neutral rate? The neutral rate is the interest rate that neither stimulates or restrains economic activity. It's just, we're running basically on trend. It's determined by a lot of forces. What determines this R star? Demographics, productivity growth, global capital flows, and demand for safe assets. What's most important about it, it is not something the Fed controls. This is out of the Fed's hands. It's something the Fed tries to estimate and navigate toward, but it doesn't directly control it. So the forces, it's worth stepping back and say, what are these forces that define R star? They are shifting in very important ways. Demographics are a headwind. We are shrinking as an American population. We're not replacing ourselves. We're not having enough babies. You know, our birth rate is not a replacement rate. And with the immigration policy, we're not bringing in lots of new immigrants. So we're flatlining on in terms of our population. We're aging. We, the boomers, are going into retirement, and we're not going without a fight, right? But we are going. Birth rates are low, and so on. So my friends at the Penn Wharton budget model project, for example, that the current deportation policies could reduce the U.S. population by 5 million by 2028 and shrink GDP between 1% and 3%, depending on the duration of how long this stopping of immigration happens. Fewer workers also mean fewer demand for capital investments, which also pushes R star down. Productivity, on the other hand, could be a tailwind if AI delivers on its promise. Again, the Penn Wharton budget model estimates that generative AI will increase productivity and GDP by 1.5% by 2035, with the strongest boost to annual productivity growth occurring in the early 2030s. These technologies take a while to absorb, and so we're going to see this about 5 years from now. That's typically what you see with new technological innovation. Over the long run, they estimate AI will lift GDP by nearly 3% from where it normally would have been by 2055. And then if you're really bold as a forecaster, they have a forecast of 3.7% by 2075. We're all going to be pretty much dead by then, so we won't see it. If those gains materialize, they would push R star higher. Demographics down, productivity up. So what's the evidence say? There's estimates all over the map. My old colleague, John Williams, the president of the New York Fed, he has a very well-known estimate. They used to be near 0 for R star. They're now about 0.8. But the modal tendency, that is the central tendency of those estimates, if you put them all together, is around 1 and 1.5% of what this R star is. So who cares? Because that's the real rate, the neutral rate. If you add on 2% inflation, then you get to the nominal rate that's just the economy idling at trend, and that gets you to around 3.5%. So where are we? We're pretty much at neutral, I mean, if that's true. But the thing is, we don't exactly know what R star is. You can't measure it directly. You can only infer it. So, you know, I think we're getting close. And we may already be there. That's why I think we should be cautious with any more increases and just sit here and maybe make one more cut. One more factor, though, looms large in this picture, very large, which I assume we'll talk about when we sit down. Chair Powell's term as chair, not as governor, as chair, expires on May 15th. President Trump has nominated Kevin Warsh to succeed him. Warsh is a former Fed governor with a generally hawkish leanings on inflation. Now, leadership transitions always introduce uncertainty, but the Fed in particular, its institutional credibility depends on continuity and independence. Both will be tested in the months ahead, and I know we're going to be talking about that, I hope, as we sit down. Real quickly, let's talk about Delaware. Here, the news is a little more sobering, unfortunately. Delaware's unemployment rate jumped to 5.2% in December, up from 4.9% in November. It's the highest it's been since September 2021. It's a full percentage point above the national average. So a year ago, Delaware's unemployment was 3.6%. It was running below average. So going in the wrong direction. And you're seeing this in terms of the numbers of employed and so forth. For example, Kent County unemployment's 5.9%. And so you're seeing just real challenges in the unemployment side here going in the wrong direction. On the positive side, the state's non-farm payroll employment is up a little bit since November. And so there is some job creation happening, but it's not keeping pace with labor force pressures. And as you know, far better than I, housing affordability remains a significant constraint. Housing prices here, the median house price here is $370,000. That's up 4 to 5% since last year. And with mortgage rates still high, and I don't think they're coming down substantially anytime soon, this is going to be a challenge for people to be able to buy their home. And that, as a result, is a constraint on workforce mobility and economic dynamism. People can't move. Delaware's other anchor institutions, its hospitals, universities, financial service firms, they continue to provide stability. And that's good. But stability is not growth. It's stability. And when the labor market softens faster than the nation as a whole, I think it is a warning sign for here in Delaware to start to think about why and what you can do about it. So let me close. Now this is the unleashed part with something I feel very strongly about and have been writing about. Because it's easy to treat the Fed, if you watch CNBC or any of these stations, everybody talks about the Fed all the time, as if the Fed is the only economic actor in the American economy. It's not. Big secret, it's not. The Fed can influence what can the Fed do? It can influence overall financial conditions. It can lean against inflation by cooling demand. It can cushion downturns by easing financial conditions. It can and must support functioning in financial markets through its liquidity tools to make sure the markets are functioning. Those are real powers. I don't dismiss those, and they matter. But the Fed cannot fix supply problems. It cannot build more housing. It cannot rebuild child care capacity. It cannot raise long-term productivity by itself. That's not what the Fed does. It cannot train workers at scale for what's coming at us, the tsunami of AI coming at us. It cannot rebuild our ports and our infrastructure. It cannot directly offset the price level effects of tariffs or supply chain disruptions. It can't do those things. And what I worry about is people think it can, and we know that if you forever disappoint, if people have expectations you can do something and you can't, you forever disappoint and people get angry and blame you. Don't blame the Fed. These are things it can't do. And I've been speaking about this a lot. Monetary policy cannot, let me say this very clearly, cannot substitute for a coherent, sensible fiscal policy strategy. The federal government ran a deficit of $1.88 trillion in fiscal year 2025, about 6% of GDP. That is a crisis-level deficit in what should be a stable period. There's no crisis right now. I mean, people are saying there's really no crisis. We're not at war, significant war. The federal debt now held by the public stands at 100% of GDP, projected to reach 118% by 2035. And the net interest costs on that debt crossed $1 trillion for the first time last year, more than we spend on defense, more than we spend on Medicaid. Interest payments now consume 19% of the federal revenue. 19%. When interest costs dominate the budget, they crowd out everything else. Investment in infrastructure, workforce development, research, the kind of public investments that raise long-run productivity and expand opportunity. The fiscal trajectory we are on as a nation is unsustainable. And the longer we wait to address it, the more we compromise both monetary policy effectiveness and the nation's economic future. The Fed cannot solve this problem. There are answers. I encourage you to go look at my colleagues at the Penn Wharton budget model. There are sensible things we can do There's some pain in them, but there's sensible things we can do to address this issue. This is not one we just have to accept we can't do anything about. What we lack is not good ideas. What we lack is not economic insight. It's political follow-through. We know how to strengthen all these things. We know how to, for example, strengthen workforce pipelines. We know what's necessary to make this happen. What's missing is the will to act. The Fed can do its job, but it cannot do everybody else's. So let me close with a simple summary. The economy is sending mixed signals. GDP growth remains solid, but the labor market had its worst year since 2020. Just 181,000 jobs added after benchmark revisions. January's report was encouraging, that's good, but we're not out of the woods. I mean, we got to keep watching this. Inflation has improved, and that's a good thing. The Fed did hold steady in its January meeting. It's probably going to hold through the January. It's not probably going to take a lot of action. And again, I think one more cut probably makes sense, but we're having this leadership transition in May. That's going to add some uncertainty to the markets. For Delaware, there's some work to do to really understand what's happening here. Unemployment's rising fast. So this is something to spend time on. So I spent a decade at the Federal Reserve, and before that I had the privilege, I mean sincerely, the privilege of leading this university. And if there's one thing I've learned in all those roles, in being out and about in communities all across my district and the country, the economy is not one big homogeneous entity. It's community by community, business by business, household by household, making decisions that collectively add up to something we call the economy. Yes, I do have an answer for that progressive commercial where they're sitting around not understanding how to say what the economy is. So what happens all around the country, what happens here in Delaware at this university, in your organizations, in your communities, it matters tremendously. The macro environment sets the context, but you set the direction. So thanks. Thanks for having me back, and I'm really looking forward to the conversation. Thanks.
Thank you. Our next speaker is Leland Vittert. He's the host of On Balance with Leland Vittert and serves as News Nation's chief Washington anchor. He's the author of New York Times bestseller Born Lucky, a memoir about his father's quest to help him overcome the challenges of autism. Vittert joined News Nation in May of 2021, where he's played a pivotal role in covering national affairs and delivering special reports across the network's primetime newscasts. Before joining News Nation, he worked for Fox News from 2010 to 2021, first as a foreign correspondent based in Jerusalem, and later as an anchor and correspondent in Washington.
Good afternoon. Thank you all very much. I want to be upfront with you all that I am uniquely unqualified to give this speech. I do have a degree in economics, and if only my professors could see me now. Not a graduate degree. I did, though, attend the London School of Economics, also known as the LSE, Professor. My time there is most accurately described by the LSE's other name, which is Let's See Europe. Give you a second to think about that. And my parents' American Express bill was the diploma. But my lack of mastery in their curriculum, or really any curriculum in school, is not the issue here, because I learned enough in freshman economics to understand and maybe to help explain to you what's going on in Washington today, what the professor alluded to as the other economic forces than just the Federal Reserve. Today's forum is designed, and I had to look this up before I got here, to quote, examine the economic forces shaping the year. Now, far more than ever in America, it is political forces that are shaping the economic and business world in a way we have never seen before. I got at least one nod. Thank you very much. Washington is the economic force. Politics is the economic force now that is the unknown. So a show of hands here. How many of you all think you really understand what is happening in Washington? Okay, got some work to do. The next line was, keep your hand up if you understand why it is happening, but we didn't have to do that. So let me give you a different way to look at this, because every one of you right now should have your hand up. You don't need to understand politics to understand Washington right now. You need to understand economics. And this is a room that understands economics. That's why we're all here. Ronald Reagan said, and he said this actually at a business conference, politics is supposed to be the second oldest profession. I have come to realize that it bears a very close resemblance to the first. Reagan said that in 1977, but never in American history have American politicians more closely resembled the oldest profession. Young journalists are always told, this is the one thing I learned in journalism school that was useful, follow the money. Following the money is how you get to the root of any story. Today I will show you how economics, how following the money will get you to the root of every problem in Washington, and how following the money is the answer to every question in Washington. You want to know why there are so many government shutdowns? Follow the money. You want to know why immigration reform can't get done and construction companies still have to hire illegal immigrants and creates all sorts of economic disruptions? Follow the money. As Professor Parker alluded to, if you want to understand why there are not the sensible reforms in entitlements, in the deficit, in a balanced budget, dealing with the national debt, all you have to do is follow the money. So what do I mean by that? The reason for everything that's happening in Washington, the division, the partisanship, the paralysis, the complete absence of leadership is not because of politics or political views, it's because of money. So there's two economic engines right now driving Washington. One is politicians, the other is the media. They are both following the money. They are both doing what our economics professors taught us would always happen. They are optimizing for themselves. So let's start with the politicians and a sad reality. For almost every member of Congress, this is both the House and the Senate, being in Congress is the best job they will ever have. Their sole and guiding principle is getting reelected. For almost everyone in Congress, we are increasingly in a country, especially in the House, where elections are decided in the primaries. Because of redistricting, because of gerrymandering, most congressional districts are no longer competitive. They are competitive not in the general election, but in the primary election. So take every politician, they're optimizing to keep their job. Their job security comes down to two things: not getting primaried and fundraising. And probably we should reverse those two if we're being honest and saying fundraising is number one. So how do they fundraise? They fundraise off the base. How do they reach the base? They do it by getting on cable news, by having hot takes, by taking extreme positions, by owning the other side, by never, ever compromising, ever. If they compromise, if they try to deal with the big issues through old-fashioned common understandings, giving some, getting some, coming to sensible solutions that solve America's problems, find common ground, that is considered a weakness. That is not being, in the Washington parlance, pure enough. This is not a partisan statement. I hate this. It's a both sides issue, but it really is. So if they compromise, they are going to get primaried. and whoever primaries them is going to raise more money. They will have hotter takes. They will get on cable TV more because of the hotter takes. They will give more outrageous sound bites. They will then get more clicks on social media, which leads to even more fundraising. And the flywheel spins faster and moves us farther apart. A couple of examples. Look at what's happening in Texas right now with John Cornyn and Ken Paxton. John Cornyn was thought to become the next majority leader of the United States Senate. Right now, though, he cannot compromise. He is fighting for his political life. And him trying to bring the Senate together risks political suicide. There's not a lot of profiles and courage in Washington these days. So essentially, Ken Paxton, the Attorney General of Texas, holds a rioter veto over the United States Senate. The exact same thing can be said on the other side of the aisle. Think about Chuck Schumer right now, who is terrified of a primary by AOC. The Senate minority leader is held hostage by a potential primary challenge. So for the politicians, there is no economic incentive for them to get things done. In fact, there is an anti-incentive. Getting things done, compromising, solving our problems is bad for their own personal business and for their party's business. So a country that can't deal with immigration, lurches from shutdown to shutdown, as you pointed out, now has a national debt equal to the GDP. There is now talk of the dollar no longer being the reserve currency of the world. That is clearly not in the best interests of America. We can all agree on that. So this, right now, is where the media should step in. The media should hold politicians accountable, right, for not acting in the best interests of America. Most members of the media, most media organizations, do not, no surprise here, the media has a lower approval rating than Congress. For all the people who complain about the media is just following the money. They too are following the economic incentives. 40 years ago, there were 3 broadcast networks, ABC, NBC, and CBS. And there were 1 major daily newspaper in most cities, a broadsheet, emphasis broadcasting broadsheet. Their economic model, the way they made money, the way they got advertisers, was because they had to appeal to the most number of people. They had to broadly appeal. Back then, the business incentives demanded something akin to fair coverage. And sure, there was bias, and many journalists are liberal, but that bias was not weaponized because the business model did not support it. So then something happened. It was called Fox News. I used to work there, as you heard, and kind of like private school, I was invited not to return. And I'll tell you, the person most responsible, though, for Fox News was not who you'd think. The person most responsible for the creation of Fox News was not Rupert Murdoch, it was not Roger Ailes, it was Jack Welch. And with this crowd, people still remember Jack Welch. 1993, he's the CEO of General Electric, brought Ailes in to run CNBC, quadruples CNBC's revenue and ratings. Ailes starts a talk channel called America's Talking for NBC. NBC killed that channel in order to start MSNBC with Bill Gates. Ailes felt hijacked or betrayed, so he left. And here's the key part for this audience, for business leaders out here in terms of unintended consequences. Ailes did have a non-compete in his GE NBC contract. That non-compete listed ABC, CBS, CNN, and every other known competitor at the time. What Jack Welch never contemplated is that Roger Ailes would go start his own cable network. Welch later said, "We'll rue the day we let Roger and Rupert team up." And he was right. That one moment, missing the non-compete, opened the door for the monetization of narrowcasting in America. So here's now what every television executive, podcaster, YouTuber, they all understand, that the content ecosystem is driven by outrage. Why is that? Because outrage gives people a dopamine hit. Anger, fear, resentment, these are no longer emotions. They are economic drivers. They give people a dopamine hit. And the economics for most of the media in America and for most politicians is irresistible. And the problem with dopamine hits is that the more you get, the more you need. And the more outraged, the more angry you have to be to get that same level of dopamine. So if you believe right now that pink unicorns are about to march down Pennsylvania Avenue and take over America, there is a YouTube channel for you. There is a podcast for you as well. The barriers to entry right now for that is almost zero, $25,000. You have a studio, and you too can start the Pink Unicorn News Network, coming soon. The algorithms are going to find people who are worried about pink unicorns. They will deliver them your content, and you will be able to monetize it from day one. The economic incentives for the Pink Unicorn News Network and for the YouTuber behind it is to never, and I mean never, intellectually challenge their viewers. Because if they do, they know someone will go out and find the real Pink Unicorn Truther channel. The more extreme one that will continue to reinforce their views. And this is where these two engines of politicians, their economic incentives, and the economic incentives of the media come together. And this is where we understand the political forces in Washington. The media pushes politicians who shout the most extreme things, the most outrageous, the most angry. They create the economic incentives for the politicians. The politicians take those clips and fundraise off of the outrage, and then the flywheel keeps going. There's a response to the outrageousness from the other side. They get to fundraise, and both sides move farther and farther apart. So since this is an economic audience, let me give you a thought experiment. If you poll Americans right now and say, do you agree or disagree that China is the biggest geopolitical threat facing America right now, the number is about 70%. Fairly obvious answer. Now you take that exact same group of people and rephrase the question. Donald Trump says China is the greatest geopolitical threat to America. Do you agree or disagree? Or you say Gavin Newsom says China is the greatest geopolitical threat to America. Do you agree or disagree? You are going to get wildly different numbers when you ask the questions that way. That's not because people's view of policy has changed. It's because people's view of policy now depends on the person who's saying it. By the way, that also applies to tariffs, something we've all figured out. So that is a different America than we have ever lived in. This is America now built by the economic incentives that I have described. So until the economic incentives change, Washington won't change either. And I'm sad to report to you today, but as I mentioned, I do not have a degree in advanced economics. But you don't need one to explain what I just have. The good news, now when anybody at a cocktail party laments how divided America is, or that they don't understand Washington, you can tell them to just follow the money. But this is the point of the speech where I should offer some type of solution to our problem. That would require the master's degree that I didn't get. Although I do host a cable news show at 9 p.m. every night. We hold both sides accountable, in case you haven't watched our promos. There is hope. The demand for fair news, for real news, is up. Our ratings are up between 50 and 75% of the year, or year over year at News Nation. If you watch News Nation, thank you. Tell your friends. If not, give us a chance. Michael Farr told me I was allowed to do one plug in my speech. That's it. But I'll leave you from a place with some lessons from places that did fall apart. And that's always the concern, as you alluded to and others have, of that America will somehow fall apart. So I did 4 years as a Mideast war correspondent. I covered revolutions, civil war, interviewed a failed suicide bomber, got shot at a bunch. The good news is that the countries that I covered that fell apart did not fall apart because they were divided. Division is healthy. Division is something that is old as civilization itself. They fell apart because nobody could figure out how to make peace more profitable than war. America's version of that war is not fought with bullets or missiles or bombs. It's fought with cable news hits and with politicians' fundraising emails. That is the war we're in right now. But the underlying economic incentives are really the same because, as we know, the laws of economics cannot be repealed by anybody. So if there is an answer to all of this, it will not come from Washington, I promise you. It is going to come from people who understand economic incentives and who understand how to change the economic incentives for the people in Washington. So in that sense, for as powerless as so many people say they feel about politics in Washington, if the economic incentives are going to change, it's going to have to start in places like this room. With that, thank you very much. Look forward to your questions and answers.
Thank you, Leland. Because Carlos read Michael's bio earlier on, Michael asked that I skip it. And I think we've all heard it enough times anyway.
Okay, that was awesome. That was awesome. You were awesome too. Like, that was the best. Hell, we should have waited to have you as a speaker till you got out of the Fed. That was fabulous. That was fabulous. Thanks again. I'm going to do something that I haven't done here before. I'm going to stay here. I'm not going to come over here. And I'm going to actually get through some prepared remarks. First, every time I'm here, I think about my friend David Lyons, who thought that this was important for the community. And he and Jim O'Neill came together and said, we need to tell people about entrepreneurship, and we need to tell them about economic, and we got to get people to pay attention. It goes to the heart of what Leland just talked about. We have to own this. We're following the clickbait too, right? Do you get really angry about this stuff? I do. You know, my son challenged me the other day. He said, you know, Dad, this was haunting for me. He said, you know, you have this abiding sense of optimism. I mean, I throw these challenges at you and you say, oh, yeah, but it'll be okay. The pendulum will swing back. It'll work out, son. Don't get too upset about it. Things go on. America continues to expand. Reasonable people will win out. He said, Dad, when does that optimism become denial of a new reality? When is it really a little more cowardly to reside in the comfort of that abiding optimism and basically not face the real challenges at hand? When evil takes hold, it's when good men are silent. I didn't have an answer for him, and it was chilling. And I still don't, but I'll tell you, he's got me thinking. He's got me thinking. If he got you thinking too, probably good for all of us. I'm going to begin with a simple observation. I agree with everything Pat Harker said. I loved what you said. The U.S. economy is pretty strong, but it's not balanced. And that distinction matters. Because when economies are strong but narrow, when markets are rising but are concentrated, when inflation moderates but risks linger, when debt climbs but optimism remains high, that's when discipline becomes more important than enthusiasm. That's when discipline becomes more important than enthusiasm. So I'm going to walk you through 3 big ideas today. One, the economy is pretty resilient, but is increasingly uneven. The structural risk, I wrote this before I heard you, the structural risk is fiscal, not monetary. Mr. President, it's not monetary. Long-term return expectations must be reset lower. I'll close what that means for what I think it means for investors. So we can start with the good news. The U.S. economy continues to outperform most of the developed world. Growth is held up better than almost anyone expected. Corporate earnings remain solid. Unemployment is relatively low. I think there's an economic reason for that, by the way, and I think it goes to tariffs. A lot of the tariffs haven't been passed on. They've been eaten by the companies, and they haven't passed them on. They're getting ready to pass them on, so watch out for tariffs. But if you're a CEO and you're watching your margin get squeezed, the one thing you're not going to do is go create jobs. You're going to say, wait, let's hold off on that hiring. I think that's the backdrop to this low, languid economic hiring, employment situation. I think 2 forces are powering the current expansion. First, we have this massive investment in artificial intelligence. It's been so massive that Amazon got nailed for it because they said, well, you spent $200 billion on this R&D and this new expense here, and are we going to get returns on $200 billion? That's what investors wanted to know, and they took the stock down. We're witnessing an extraordinary build-out in data centers, cloud infrastructure, automation systems, and capital spending tied to AI has become a major driver of economic activity. The second is consumer spending. But here's the nuance. Consumer spending is increasingly concentrated at the top of the income spectrum. The top tier of earners, buoyed by rising equity markets and home prices, have driven much of the consumption strength. In fact, the top 10% of the economic cohort spent 50% of all the money that was spent last year. Flip that. 50% was spent by the other 90%. Now, that almost argues an argument that you wouldn't think was really possible that goes to the velocity of money. When you put so much of it in so few hands, do they really have the ability to move it effectively? Last year, they did. Household net worth has risen dramatically over the past 6 years. Asset prices have created a powerful wealth effect. The middle and lower portions of the income distribution feel very differently. Inflation has taken a lasting bite out of purchasing power. More families are living paycheck to paycheck. There are apps now for buy now, pay later. They're apps. You can get them on your phone as you sit here. People are using them, buy now, pay later, to buy groceries. Delinquencies are rising at the margins in mortgages and on credit card loans. They're rising. Delinquencies. People are still suffering. The labor market is cool. It picked up in the last month. That was really good. But it's not a weak economy. It's an uneven economy. And uneven expansions tend to be more fragile than broad-based ones. Inflation has improved, but it is not conquered. Recent data show moderation. Energy prices have helped. Market-based inflation expectations have declined, which is weird to me. George Will said in a column recently that it is the stated intention of the Federal Reserve, if the 2% target for inflation is to hold, to devalue the dollar by 50% over the next 36 years. Rule of 72. 2% a year, compound, will reduce the value of the dollar. That's their goal. But if it's running at 3%, that devaluation happens in 24 years. So somewhere between that 2 to 3% range in there, compounded, drops the value of the currency. If that's going to happen, you need to own stuff. You got to own some stuff. You bury it in the backyard or in the mattress, not good. All right. Inflation is still, I believe, with us. Lost my place. All right. I think it would be a mistake to declare victory on inflation. So there are a couple of forces that I think remain inflationary. Tariffs and trade uncertainty, fiscal stimulus layered on top of full employment, reduced immigration, tightening the labor supply. Hasn't had an effect yet because there hasn't been a demand for that labor. You pick up in that demand, you pass on some of those tariffs that start to get passed on, and the consumer starts to pay for some of those prices. The demand and the hiring will pick back up, my opinion, but that happens. The demand will come back. Those CEOs that have been reticent and reluctant to go ahead and hire will do it. Political pressure around interest rate policy is a real risk for inflation. Political pressure on interest rate policy. I went to a dinner in Washington last month where the president spoke, and Kevin Warsh was there. And the president, Jay Powell, was there. He criticized Jay Powell. This was all in the newspapers. If you didn't see it, I'm not telling tales out of school. I would be, but the newspapers got a hold of it. And he criticized Jay Powell as too late Jay and being a moron. And then he looked at Warsh and he had him stand up and he said, he's from Central Casting, isn't he? He's very handsome. Doesn't he look like a Fed president? He should be Fed president. Look at him over there. He's very handsome. Stand up, stand up. He did. He says he's going to do the right thing. He's going to get in there. He's going to lower rates. If he does, quoting the president, if he doesn't lower rates, I'm going to sue his ass off. I'm just kidding. Well, maybe. That's what the president said. Kevin Warsh then sat down. You would too. The Federal Reserve has cut rates, and yet long-term rates have not come down meaningfully. That mortgage rate, that 10-year Treasury rate, they haven't come down. There's a 220 basis point spread between Fed funds right now and the 10-year Treasury. 222 basis points between that short rate. That's not as huge as it ever gets, but that's a lot bigger than it's been in recent years. Why? Why? Markets are skeptical. The bond market is looking at deficits, and it's looking at debt issuance to fund that $1.8 trillion in deficit spending. It's looking at inflation risks, and it's demanding compensation. Pay me some interest rate that's high enough to lend you my money. In this cycle, markets may be exerting more discipline than policymakers. There's a structural risk, too. And the structural risk here is fiscal. The greatest long-term economic risk facing the United States today is not the Federal Reserve. It's fiscal policy. The pandemic response was massive and necessary at the moment, but the long-term consequences are now with us. You remember we were here together, and I said, we're doing stuff and we don't know the consequences because we've never done it before. We had a huge buildup on the Fed's balance sheet. Huge. Hadn't seen it before. Was it the right path? Federal debt has surged. Debt to GDP is historically elevated. Per capita debt, now $112,000 for every man, woman, and child in this country. Do you have children, grandchildren, great-grandchildren? Every one of them, $110,000, $112,000. It has surged, and the debt service is consuming a growing share of the Federal Reserve. Every dollar spent servicing debt is a dollar not spent on infrastructure, research, defense, or education. Brent Scowcroft wrote the foreword to the beginning of my book, Restoring Our American Dream. He said this, and I've told you all this in previous years. I grew up in a time in America where the rules were duty, honor, and country. That's what we learned at West Point. And where parents would work hard and sacrifice so their children could enjoy a better tomorrow than they had enjoyed themselves. I fear that we may be the first generation who has borrowed from our children to better enjoy our lives today, and we will be culpable of handing them the bill in the terms of the U.S. debt for generation upon generation to come. I really hope that is not our legacy, said General Scowcroft. Tariff revenue will not solve this problem. Trillions of dollars of debt roll over and interest rates go up, financing costs rise further. This is what economists call fiscal dominance, when fiscal realities constrain monetary policy. Why, if they've lowered rates to where they've lowered them, have we not seen a kick? Have we not seen mortgage rates come down? Have we not seen this happen? If investors doubt long-term fiscal discipline, long-term rates stay high. And that changes everything. It changes equity valuations. It changes real estate affordability. We're already seeing it in the housing market. Home affordability is as low as it's ever been. It changes corporate borrowing costs. It changes government flexibility. The government loses flexibility because it has to pay for the debt, unless you're going to default on the debt. Higher for longer might not be cyclical. Higher for longer might be structural. Where does growth come from? There's a powerful counterbalance. The growth equation is very simple. We talked about it earlier. The demographics are challenging. We're not meeting the replacement rate, meaning more people are dying than being born in this country. We used to have immigrants come in. One of the early rules in economics, if you're studying any culture, is if they've got a growing demographic, if they've got a growing population, they should have a positive economy. We don't. We don't. So, where's it going to come from? It's got to come from productivity. If I can't grow my workforce, I've got to grow productivity. Well, AI's doing it. This is great. How big's AI going to get? I don't know. Don't know. It's pretty damn powerful. I mean, it's amazing. I think the word was a tsunami coming at us that President Harker used. So we're counting on it, and maybe we'll see labor productivity increase the way it did in the 1990s. Maybe we could see a sustainable expansion without inflation. So, I've gotten on the wrong page again. It's a reason I never do this with this damn written speech. I'm better when I dance around the stage, I think. It's here, I promise. You're not going to get off that easy. Okay. Firms might be able to raise wages without raising prices. It would improve living standards. We'll see. If this productivity kicks off, it will expand economic capacity. The question isn't whether AI is transformative. It is. The question is, for me, have markets already priced it in? Or have they priced in too much? Have we gotten out and over our skis too much? Is a recession coming? I get this question a lot, and it's the one I've gotten wrong for about the past 5 or 6 years with you all. When you look at all the historical predictors of inflation, of recession, they were all lined up. About 80% of them suggested, yes, we'd go there. You show me Vegas odds of 80% of it, something's going to happen, I'm going to put my money on that particular square. You know who said it wasn't and who said we weren't going to go into a recession? Harker. And he argued with me year after year. And I kept going, I'd stand here and say, he's got to say that, right? I mean, well, he does. I mean, he did. I mean, you can't be the Fed president of the Philadelphia Federal Reserve Bank and go, yeah, we're going into recession. I mean, can you imagine what would happen in the press after he got out of here? Can you imagine that call from Jay Powell? But talking to him on the side, he said the same thing. It's important. Also, what he said today about the credibility of the Fed was something that Charlie Plosser said to me years ago when Charlie Plosser was here, and he and I did this together. But he talked to me over drinks one night when we were here before, and he said, Greenspan did the Fed a disservice. And he said, Greenspan projected this Yoda-like wisdom of I know everything and I've got it in my pocket and I'm so damn smart and you can't understand me and just listen to me and everything's going to be fine. You can't make that kind of a promise if you can't deliver that kind of a promise. And as Pat said, the Fed doesn't have the tools to fix everything. And so really, he put the Fed more at risk. When I asked another Fed president in 2009, because I really wanted to understand this, in 2009, when the market bottomed, I don't know if you remember it, I don't know if you remember that the bond prices on banks were at 50 cents on the dollar, and markets were continuing to crash into the beginning of 2009. I finally asked this one Fed governor, after all of it was over, I said, Why did it bottom? What should I have seen at that moment that I didn't see? What turned it around? And he gave me this nonsense answer. I said, "You're not going to answer me?" He said, "Okay, I'll answer you. You believed us." I said, "What?" He said, "You believed us." I said, "What do you mean?" He said, "We told you that we were going to have stress tests of all the banks, and we were going to do it in 30 or 45 days. I think it was 30 days. And then we reported back to you. We never told you what the stress tests were. We never showed you the criteria. We never published any of it. And then we told you that 85% of the banks in this country were sound. And we told you that 10% needed remediation and 5% were real problems, and that everything was fine and the banking system was fine, and the markets went back up. It's the full faith and credit of the United States government. And you have to have that full faith, justifiable faith in the Federal Reserve. And if we lose that faith, if we have a cause to lose that faith, we, ladies and gentlemen, are in trouble, and so is the world's economy. I can't see Jen back there, but I'm sure she's getting irritated with me. I'll try and jump forward. Equity markets, S&P 500's at an all-time, near its all-time high. It trades above the long-term valuation multiples big time. 22.5 times next year's earnings. Profit expectations, margins, earnings for this coming year are 14.9%, and the following year, 15%. If you're a CEO and I tell you you've got to grow your earnings on the bottom line by 15% in back-to-back years, I promise your heart is going to start to palpate. And it should. That's a huge number. That's a huge hurdle. And we've had 3 years in a row, right, of 20% markets, of bull markets, and we're trading at all-time multiples. So if we got that, and if those multiples don't expand, we get 15% a year out of stocks for the next 2 years. Well, that'd be wonderful, but I don't believe it. I think after things go up a whole lot for a long time, they come down. So what could derail this expansion? I think a resurgence of inflation, escalating tariffs, rising long-term rates, credit stress, unrestrained deficit spending, political dysfunction, and politicization of the Fed. Get that tennis ball off of your court, Mr. President. Perhaps the greatest risk is complacency. Extended bull markets tend to produce risk perception precisely when caution is most warranted, right? We feel the best right when you should be most cautious. So for investors, I think strong balance sheets matter. Durable competitive advantages, consistent free cash flow. Cash flow solves a world of problems with companies. In the fall, 38% of the S&P 500 is made up of the Mag 7. That's now dropped to about 29%. So there's been a shrinking, there's been a broadening. But if you think that something like 38% were those 7 stocks, the rest was 493 companies. There are opportunities there. There are things that haven't participated. But don't forget, when the whole thing goes down, everything goes down. Everything goes down. The really good ones don't go down as much. So I think diversification matters, balance sheets matter, valuation and discipline matters. The goal is not to chase headlines. The goal is to build portfolios that can endure. So despite the challenges, I think 4 or 5% in earnings and 2% in the dividend, and you can get a 7% return for the next couple of years as things return to a more normal level from these very elevated levels, would be a really good thing. Never bet against the United States. We have a free capitalistic society where innovation is rewarded. We have deep and liquid capital markets. The banking system's in good shape. We have strong contract and property laws. We have a stable democratic government. We have a stable... Who wrote this? We have a democratic government. We have a government, damn it. I know we do. We have an educated workforce, and we have an entrepreneurial culture, and those entrepreneurial feelings and senses are being fostered and stimulated and encouraged exactly from the University of Delaware, from the work James O'Neill started, and Carlos is continuing. God bless you all. So I can remain constructive over the long term, but the era of easy money and effortless gains, I believe that era is behind us for the time being, and the next decade will likely reward prudence, patience, and thoughtful risk management. This economy is resilient, the risks are real. Investors who recognize both, investors who act with discipline, will be well positioned for what comes next. I can't thank you enough. It's a great honor, and Pat and Leland will come up and do Q&A and other things, but thank you all very, very much. Okay. Oh,
Good job.
oh, thank you. Good job to you, yeah. Oh, boy. All right, well, where
The
to
Q&A
start?
that gets you in trouble.
Where to start? We hope the Q&A
Good trouble, as somebody said.
will get us in trouble. I'm going to ask you both the same question, please. Oh, by the way, our moderator canceled 2 days ago. Nick Temeros canceled on us, so we can all joint moderate, but I have the magic board. Kevin Warsh, I had a long talk with him a couple of weeks ago, and I said, "Are you ready?" And we were talking alone privately. He said, "I'm ready. I'm ready to do it. I want to get started right now. I'm ready to go." I said, "You're an idiot." I did. I said, that's exactly what I said. You wait until the last possible minute. You hide behind Jay Powell as long as you can. And then I said, you know, this is going to be the hardest job, I think, in Washington, because he knows what he's doing. This is a really smart guy. He's been hawkish, and he gets it. And the question is, will he do it? Or will he bend to the intense short-term political pressure for even greater consequences? I told him, to our children and grandchildren and great-grandchildren, and the fate of our economic future could very much be in his hands. So that's where, and I just hope that he would listen a lot. And he says, I got it, I'm going to do it. And go, okay, good. What advice would you, Pat, give Kevin Warsh? And can anybody stand up to the pressure the Fed is enduring?
Yeah, I think so. I think Kevin can. I think Kevin is a seasoned professional. He's clearly qualified for the job. He's said some things that don't quite add up, but that's how you get the job, right? So some of the things he said he's going to do are impossible to do. We can talk about those, one in particular. But remember, the chair has a lot of say. But the chair, when it comes down to the vote, is one of 12. And the pushback happens not just even with the voting members, but early on in the process, before every meeting, the chair would call. This started with Bernanke, and Janet kept it going, and so did Jay. And if you push back enough, the chair has to get a consensus. I mean, the chair can't just do it all on their own. And so if you look at the committee right now, all the presidents, all 11 of the 12 were renewed. One decided to retire. So there's one opening in Atlanta. The rest of the 11 are still in the room. The governors, there's only one slot currently open, which is Byron's slot, because you think it's Jay's slot, but Jay can stay on.
Will Jay stay on?
So Jay, let me be clear. Jay, his term as the chair of the board ends in May. But his role as governor, he has 2 more years to run, right? So he could. I don't know if he'll do it. If you asked me a couple months ago, I'd say there's no way in hell Jay's staying on. I don't know now. I honestly don't know. I've not talked to him. I don't know where his head is. But so there's not a lot of change on the committee. So if Jay leaves, there's just 2 out of 12 when vote, 2 out of 19 in the room. There's not, so consensus, it's still a consensus-driven institution in the sense that the chair can put his or her thumb on the scale pretty heavily, But they have to back off if the committee is, if they're losing the committee. I mean, I could tell you before I left, so here's a little sort of inside baseball in the FOMC. So we shut down all public commentary 10 days before the meeting. We're not allowed to say anything because documents start getting floated. A whole host of documents, including drafts of the policy statements, right? The statement that's at the end of the meeting, drafts of options to vote on, and they get circulated and pushed back on. If there's enough pushback, we started to see, so the meeting starts on Tuesday, everybody gets down there on Monday. We were seeing, in some cases, drafts that were coming in over the weekend, revisions, because there was continued, so don't think the chair can decide things all on their own. By the way, there's one little quirk that people don't know, which this is really, I doubt this would ever happen, but the president gets to appoint the chair of the Board of Governors of the Federal Reserve System. Every January, the last meeting the Fed just had, the committee votes on the officers of the Federal Open Market Committee. By tradition, the chair of the Board of Governors is the chair of the FOMC. It need not be so. The committee could decide to make somebody else chair. That's kind of the nuclear option, right, for the committee to say, hell no, we're not going there. I don't expect that to happen, but that's always in their back pocket, that could happen. It would be highly, highly unusual. It never happened before.
I've known Jay for 30 years or more. And I talked to him over the summer, and I said, last summer, I said, you're going to stay till May, right? And he said, yeah, I will be there till May. I am counting the months, weeks, days, and minutes. Did he say this to you? Right up to the last minute, and then I am out of there. I am out of there.
I don't know now.
I don't know now either. He's been slapped in the face.
That video he put out was a signal. That was highly unusual for a Fed chair to do that. Highly unusual.
All right, Leland. You've got this debate going on with the Fed, the pressures on the Fed, and you've explained to us we need to follow the money. How does your following the money better inform you as to what might happen here and what you expect and how the pressures could build? And is there real profit in this, I don't know, kerfuffle at the Federal Reserve? Why not just direct it elsewhere?
Oh boy. First of all, I would say you're wrong. Whether Warsh is confirmed or not, he will not have the hardest job in Washington. The hardest job in Washington is Donald Trump's teleprompter operator or the guy who deals with your scripts. So that's number one. Number two, if you go back and study Donald Trump from the beginning, he always has a foil. Doesn't matter what the situation is or what the issue is. He always has some kind of foil. Mm-hmm. And on the economy, at least for a while, it seems to have lapsed a little bit, he made Jay Powell the foil in any of these situations. That's how he's operated. That's how he operated when he announced in 2015 running for president, and that's how he deals with things. To me, I thought the most interesting part that's come out of this is what you said, Professor, which is how the power of the Fed is becoming less and less as the fiscal issues keep getting worse and worse.
Yep.
And whether, and I think that's why we've seen, especially lately, this shift. If you watch CNBC now, certainly in the broader news world, a shift away from focusing on what the Fed is doing and towards a focus on what the political forces that drive the fiscal forces are doing.
Yeah.
You want to add?
Yeah, I mean, the one thing that's coming at us, though, which politicians will have to react to save their skin, is the current forecast is the Social Security Trust Fund runs out of money in 7 years. which means, roughly, I'll just rough numbers, 75% of Social Security is a pay-as-you-go system. Our payroll taxes are funding it. 25% comes out of the trust fund. If the trust fund runs out of money, there's an automatic 25% reduction to benefits to every retired American. Do you really think politicians can survive that?
I think politicians will do the one thing that is always safe to do in Washington, which is to spend more of our money that they don't have.
Yeah.
And they will agree in some way to deal with that. Because, on every one of these major issues, whether it be Social Security, immigration, entitlements really tie into the national debt. On every one of those issues, they are, number one, far too difficult to solve because they require compromise that goes back to compromise costs you your job. And number two, they are much better as campaign issues than they are as solved issues. The solution to the fiscal problems are pretty well known. Of some pain, but index Social Security life expectancy, and somehow you solve a lot of your problems and move forward. The same as the immigration debate.
Right.
The solution is well known. Same with the Israeli-Palestinian debate. Solution is well known. It's whether there's a political economic incentive for the politicians to get to that solution.
So let me ask, can I just go? So there was one shining moment in Congress where they did something very unusual, the Base Closing Commission, right? Here's a case where there's a commission that decides which military bases to close, and Congress can only vote up or down on their recommendation. They can't amend it. So they can say, I hate this is happening to my district, but I had to vote for it anyway. Could we do something to give cover in these other issues?
Sure, if Congress wants to give away that power, sure.
So how do we take it from them?
Well, there's a guy currently in the White House who likes to take a lot of power away from Congress. And I don't know how you take that power away. There's starting to be a demand bubbling up more and more for solutions.
Yeah.
The cable news markets and viewers, we always say represent about 30% on this side, 30% on this side. I think of what I do and like News Nation, that I don't speak for it, but I speak for my show at 9 p.m. A little bit like
Once I said you could do it once.
6 p.m. Pacific.
set your DVRs. But I think of myself a little bit like the West Virginia coal truck driver. I take my half out of the middle. And that the middle that used to be ignored and the middle of America politically that was thought to be apathetic because they went to their kids' soccer games and didn't really care are now becoming much more involved.
Yeah.
I want to go back and just mention one thing about tariffs because I think about this math a little bit differently. If we have a $1.8 trillion deficit, which we had last year, let's not call it 1.8 trillion. Let's call it 18,000 billion. Okay? 18,000 billion. Is that right? Yeah. 2,000 billion. 1,800 billion. Sorry. 1,800 billion. 1,800 billion. And as Pat said, tariffs made up for 100.
Yeah, minuscule.
10%.
Minuscule. And the money that was brought in from tariffs is being sent out, too, in new fiscal spending. The bonuses to troops and the military and others. It's big.
Yeah.
But 1,800 billion.
And by the way, we can talk about this, but AI is not going to solve this problem either. Not even close.
Not even close.
It will tell you it can solve it.
Yeah, sure. But it can't.
So we have a question from the audience. How can our national debts, Pat, be controlled in the future? What political structure would support that?
Well, I think this is the political side I'll throw here.
Yes.
I mean, there are solutions to this. I refer again to my buddies in the Penn Wharton budget model. They have a really nice report on 13 things we could do. When added up, doesn't reduce the deficit, let's be clear. It just kind of bends the curve, right? And there are things like entitlement reform, healthcare reform. really, that's the game. We can get rid of the rest of the federal government except for defense and entitlements, and we still run a big deficit. So politicians like the smokescreen of DOGE that's going to save the deficit issue. Not even close, right? 85-ish% of the federal budget is defense, entitlements, and interest on the debt. You can get rid of that 15% and it won't make a difference. What I worry about now is it can go in the opposite direction by killing the seed corn of America, which is research, innovation. And that basic research is driven right here at the University of Delaware and universities all around the country. By cutting that off, we're setting ourselves up for an even worse situation. So that's what has to be addressed. But you need to do it in a way, bring more revenue in, but you can't stifle growth. You can't crush growth. So these guys figured out 13 things. There will be constituencies for each one of these that people will hate, like changing capital gains taxes and stuff like that. But they add up to something that actually could bend the curve. But politically, I don't know how we get there.
Yeah. So typically, it comes out of a crisis in one way or another. It's the last time America really came together, the highest approval rating any president's ever had was George W. Bush after 9/11.
Yeah.
And he was able to sort of do whatever he wanted, and he, to his credit, tried to do immigration and Social Security reform, and it ended up sort of blowing up as his popularity waned with the Iraq War. But that typically has been the only thing that brought us together.
Pat, I had other of your colleagues here over the years. When we look at this amount of debt, approaching, 38 trillion, 39 trillion right now, and growing. If we look at this much debt, I said, how do we get out of this much debt? GDP is somewhere around $30 trillion. If we add to it at 1 to 2 trillion a year for the next, 2 trillion a year for the next 10 years, we've got $20 trillion of debt. You add other spending from the government, the Big Beautiful Bill Act was another $4.2 trillion. Okay, maybe you can get GDP to 40 trillion over that 10 years. And then all of a sudden you're going to have 60 to 70 trillion dollars in debt. And then you're not 100%.
Right.
You got a big problem.
You have to make the American people care about it, which right now, if you ask them in terms of their worries and their concerns, the national debt is quite low.
Yeah.
The only time that the American people ever started caring about the national debt as a major problem in America was there was a move done. A couple of very rich guys hired a public relations firm in D.C. to try and get people to begin caring about the national debt. This was about in the single digits of trillions. They kept thinking how to do this. They kept putting up posters. The national debt's 8 trillion. Worry about the national debt. Didn't move the needle. Then they started educating people about what a trillion was, what you did, and suddenly everybody started caring. And it's 18,000 trillion, or 18,000 billion, right? Because 1 trillion is 1,000 billion. Mm-hmm. And once you start explaining to people what a trillion really is, they start naturally caring about the debt.
Reagan did it. How many stack of dollars that would go up and around the moon? Do you remember from those? It's a smaller number that were around when Reagan. I've seen a lot of dark hair in this room.
Now we get to Pluto.
Now we'd get to Pluto, is exactly right. Other Fed governors and economists have said the only way out of this much debt is to monetize it, is to have inflation, that inflation becomes a good thing. And here's the basic notion, that if you buy a $500,000 home and put a $250,000 mortgage on it, and the house goes up over a couple of years, 3 years, 4 years, one of these hot periods, to be worth $1 million, what you had at the beginning of a $250,000 loan on your $500,000 house was 50% debt to equity. You haven't done a damn thing except the price went up. It got inflated to $1 million, and now you've got 25% debt to equity. So if we can inflate the dollar and reduce the value of the dollar, we're reducing the value of the debt. And the thought was we can't grow our way out of this. True, false, too pessimistic, or should we?
Yeah, but think about if we go back it's in our recent memory. Let's go back to the inflation we had in the pandemic. What went along with that? We had a real problem with growth.
We had a lot of growth.
Yeah, but over time, it just eats away at the economy.
Yes.
And you can't stop growing and solve this problem, right? That's the worst thing to do. You've got to grow. I mean, think of the 90s. How did we do it? We grew, right? We grew. So that kind of level of inflation over a period of time, it just eats away at an economy and it stifles growth over time. Just look around the world of countries that are running these high levels of inflation. That's not the solution. Everybody's looking for a quick fix. Right? That's the quick fix. We'll just inflate our way out of this. Well, first of all, that's assuming we're a closed economy and the rest of the world isn't going to react either, right? So the math just over time doesn't add up. We've got to confront the issue and solve the problem and stop looking for quick fixes. There is none.
AI going to save us?
So here's the best estimate from my buddies. I keep referring to them, but I'm involved with this model. So their best estimate is about $500 billion over about a 10-ish year period that we'll see increased in terms of being able to add to the issue around the deficit, right? That's not even close to the problem.
No.
Right? And, these technologies, nothing lasts forever. So if we go back throughout history, economic history, we've seen this cycle over and over. We overbuild the railroads. There's a lot of hype about the railroads. A bunch of railroads go bust, and then they leave some productive capacity. We pick it up and we figure out how to use it. Same thing with electricity. 90s, we built a lot of fiber optic cable all around the world. A lot of those companies went under. People came, picked up the pieces, and built the internet. This is the cycle we always go through. People are saying, well, this time's different. Every time people said this time's different.
Yeah.
Right? I don't see it being any different. There are going to be some of these firms that are going to fail in the AI. We don't know which ones. If you knew which ones, I wouldn't be on this stage, I guess. I don't know. But
I think maybe.
that's not going to be, that. We know this is going to be hype, and it takes a while for these technologies to be absorbed. If you remember the management buzzword of the 80s, re-engineering with technology, it takes a while for companies to figure out how to use these technologies and reorganize their production processes. That was true with electricity. If you look at the early days of electricity, they put the machines in the same mills next to the waterfall where they're getting their power. They didn't move the machines around. They just ran the electricity to where, then finally they decided, we don't have to keep the machines where they are because the electricity lets us move the machines. That took a while for people to figure out. This is going to be the same. It's going to affect, the best estimate is about 40% of the workforce. But why we're freaking out about AI, I think, collectively as a society, when the factories were getting automated, how many people worried about it? Unless you were working in a factory, you didn't care. You're just getting cheaper cars. It affects us, white-collar workers. That's the difference this time. But the trend is not any different. The process we're going to go through is not any different.
I had a CEO, I gave a speech last month at a CEO group in Palm Beach. And they had a bunch of CEOs, very successful folks. And this guy came up to me afterwards. He said, Mr. Farr, he says, I'm a manufacturer, and I knew who he was. This guy was pretty big. And he said, I got my main plant's in Alabama. And last summer, he said, my guys over the past year went through a proposal, and we replaced a whole bunch of machinery with AI-driven machinery. We had voice recognition, we have cameras on it, and it cost me $4 million in my Alabama plant. I replaced 16 workers, and it's going to pay for itself completely in 2 years. 2 years. He said, and then it just keeps going. And it doesn't take lunch breaks, and it can tell me when it needs to shut down, and it's on top of it. I mean, it's on top of it, is what he said. I was like, good, I'm glad it's good. But it kind of begs the question, What happens to those 16 jobs? I mean, if that becomes a real pattern around, it sure seems like it's going to. I mean,
No, we are already seeing dislocation in the labor force because of AI. And by the way, just the economic facts here. You need to get productivity growth to stay on trend, you need technological innovation.
Yeah.
The question is not, is AI going to create technological innovation? It is. Will it create technological innovation that is above trend forever? And that can't be right. It can't be right? Nothing lasts forever. Now, we can estimate how long. But one of the things we are particularly bad at in America is when people get dislocated in their job, we basically say, good luck. We are terrible at retraining the workforce. So actually, a couple of colleagues of mine put together an op-ed, and we've been a proposal really to Congress around what we're calling the Digital Land Grant University. This university is a land grant institution. What was the land grant? In 1862, in the middle of the Civil War, Abraham Lincoln signed the Morrill Act of 1862. Morrill was not moral, it was a senator, he was a senator. It created land grant universities where the federal government gave states land to create universities that taught practical skills, the technology of the day. And if you read the act, it's agriculture and the mechanical arts, the new technologies of its era. We need the same thing to happen, an investment with a public-private partnership for what's land today. It's cyber land. And we need that same public investment. The problem is there's no room in this budget to do anything. And we know this has to happen. We can't leave these people behind. They need to be reskilled. And by the way, you're already starting to see this. If this is going to happen to you, go be an electrician. You know how many hyperscaler data center, how many electricians work in their peak in a hyperscale? 1,400 electricians, one data center.
Wow.
We are about 1 million tradespeople shy in America today. We need to bring back the honor and dignity of those jobs as well in America.
It would be a great use of government investment if we weren't spending it all on interest on the debt that's rising. So somewhere in there, this has to be reversed. I've got one more question for Leland, and I think we're about out of time. Quick question. We've been getting a lot of questions. We've covered a lot of them here from you all tonight. From an investment perspective, do you anticipate domestic equities will outperform international equities over the next 3 to 5 years? No. Now, well, it was too easy not to do it.
If only he would be that succinct when I have him on TV.
You would never have me back.
We'd have you back every night.
No. And I meant it. We're facing midterm elections. Normally, a second-term president, once you get past midterms, becomes a lame duck very quickly. What's going to happen in the midterms, and is it anywhere possible, conceivable, that President Trump could become a lame anything?
Well, he will do his best not to be. The one thing we've always seen with Donald Trump is that when he somehow exits the news cycle for whatever reason, he finds a way back in it, either by design or by happenstance. I would generally argue that it is always by design because there's no one who understands the media better than him. The test to that begins really today. As we've all been here, President Trump is down giving a speech in Georgia, Rome, Georgia, on the economy. Rome, Georgia is the home of Marjorie Taylor Greene, who is the MAGA firebrand, who you call her a fallen angel, whatever you want to call it. But there is 16 people running for her seat, and Trump's down there to endorse one of them. Over the next 8 months, we are going to see what Donald Trump's real power in the Republican Party is. If he maintains the power to get Republicans elected, Republicans will remain loyal to him. If that power is proven to either be non-existent or to be falling, his influence with Republican voters, especially swing Republican voters, if that is proven to wane in the midterms, then that makes him far less powerful post midterms. And a lot of that depends on the economy. A lot of it depends on, you know, people say, is J.D. Vance going to be the next nominee? Tell me what's happening with the economy, not the market, but, you know, how people feel in January of 2028. And I can tell you whether J.D. Vance will be the nominee.
Yeah.
Okay, final question for you, Pat. What's keeping you awake at night?
The fiscal issue. I mean, I think it's, this is a global phenomena. The U.S. isn't alone in this. I mean, we're all spending lots of money we don't have. And I just worry that for the long-term economic health of this country, that if we're not able to make the investments that are necessary. Think about what we've accomplished in medical science. It's incredible things that we've been able to discover and the technologies we've deployed, all funded by federal research dollars. All the internet, all started with federal research dollars. The private sector does not have the incentive to invest in something for 25 years. Where I sit at Penn right now, who invented mRNA technology that is underlying all modern vaccines, that started 25 years ago, that research. What private company is going to invest in that? None. This is the proper role of the federal government, to help build the infrastructure, help invest in the technologies, help with the workforce development that we absolutely need, the skills that we need in America. I'm just worried that where we're heading, none of that's going to be possible. Because I'm telling you, when the next crisis comes, not if, when, it always comes.
Always.
We have no dry powder to deal with it on the fiscal side. And that will just make this situation even worse. Something's going to be sacrificed, and it's going to be the things that build the productive capacity of America. Us as people and everything out there.
And yet, in the end, I was going to leave it there, but I can't. That was just too gloomy. So I got one more for you. In the end, are you optimistic that the Republic survives?
I am, actually, because I think you're already starting to see the pendulum, this has been true in American history, the pendulum keeps swinging back and forth. And I think right now, people feel like it's swung way too far in a variety of, and we didn't even get into some of the social issues, but people feel like it's swung way too far. And I do think people are getting off their couch, like you said, and saying, okay, I got to do something here. I'm going to go protest, or I'm going to do something because it's gone way too far, and it'll push back. That's been the American story.
Final word from the three of us today, get off the couch.
Yeah.
Thanks to our speakers again for coming out today. You guys have been fantastic. Just want to give a few thanks. Thanks to my brother Dave for introducing all the speakers. You did a great job proving to everyone you know how to read. I was very impressed. University of Delaware alumni, good job. But also just wanted to say, thank you to the University of Delaware. You guys were amazing. Also special thanks for the University of Delaware team, Jen and Laura, and as well as the NFP team with Jen and Caroline. So thank you again. The bar is open if you guys want to go, and let's talk to you in a few minutes.
I'm sorry?
I really liked your remarks.
Oh, thank you. It's really nice to meet you.
Yeah, same here.